So Donnie, I wanted to invite you to chat in this format because in the last year, really the last 2 years or so, the market has definitely had a lot of, since COVID, honestly, the market has had a lot of uncertainty in different directions depending on how far back you expand the timeline. And as real estate agents, we're on the same team. It affects us and it affects our consumers. And I started to have like kind of the consumer perspective where obviously I understood real estate as an asset class, but as all these headlines started zinging our way, I realized there was a lot of, I want to say almost like noise pollution without fundamental understanding of like, okay, Fed rate hikes, Fed rate cuts. What does that mean for, in our context, San Diego real estate? And something that you've done really, really well for yourself on Instagram and is kind of have a conversation with your clients via your stories. That's like your weapon of choice. And I had the thought process of, I think we would both, serve our clients better if we took that and we put it into a format like this where we're breaking things down, like the same headlines, the same concepts down in a dialogue format where I come at it, from a, almost Socratic, I know nothing and I want to learn everything. And you are engaging in that from, an informative and also a critical perspective.
Right. I mean, it's a little twofold because watching the market doesn't really dictate exact and the Fed, the financial sectors, you can't really look at that and learn that weapon, so to speak, and then know how to use real estate, as a separate weapon. They're two totally different weapons. Sure, it's a short sword and a dagger. They're kind of similar, but just because you know how to use a dagger doesn't mean you're gonna have different practices. So I don't want to overwhelm and say like, oh, it's easy to do this for real estate. If you want to know what's going on, look at this.
Yeah.
You really have to understand the financial industry, or at least to some degree, dive into that. I'm not saying get your Series 7 and stuff like that. You
Yeah.
can, which would be helpful, but you don't need to know all the things in your Series 7 to know how the markets are going to affect real estate. It's been years and years and years. I mean, talking 2019, maybe early 2020. I've just been learning that over and over, diving into it, and just I was obsessed with it because I don't know what it is, man. To be as I don't know, I like the complexity, but to make it like more relatable, I just like the charts. I like the charts. I liked that I could change the colors on them, and the layout looks cool on my computer. Like it was literally that simple. And I don't know why aesthetically, it just was something I always liked to look at. And so I'm like, well, but now what does all that mean? And I
Yeah.
started diving into it. And then I found it all, just that's how I got started into that side. But as I dove into it more and more, I became obsessed and then started saying, okay, now how it's great that I know all this stuff and it's great that I can invest in the stock market and crypto and stuff like that. How does that relate to my main profession, real estate? How does that, how can I take this knowledge that I have now and help my clients that are buying their house? Right. Because real estate is, based on leverage for the most part,
Yeah.
asset appreciating. It is affected by the financial markets, but in what ways the financial markets affected and how do I tell my clients about it? And so to what you're saying is like, there's a lot there and it's a lot to unpack. And there's no way I could just sit here and unpack it all and give you like this, and this.
Exactly.
Or to do that, I could give you a few tips, but
And honestly, that's the genesis for this format. So I feel like in this dynamic, my job is to try and freaking bound you because if I bound the discussion and target the direction, I think you're able to fill in with some amount of, exact synthesis that people need to understand. Right. That's the entire method of just like, hey, asking to understand, but also guiding the discussion in a way where it's not completely overwhelming. Because if we, you can easily, like in that brief introduction, you could easily run on for 6, 7, 8 hours
it's
if you
my
want to.
it's a
Yeah.
strength and it's a downside for me,
Yeah.
which is why I choose Instagram stories to communicate.
Yeah.
If I were to throw a YouTube video on, it's gonna be like, well, here's my 4-hour video about how my day went. But it'll be, I have to compress the words. I have to make sure, is this clear enough that, a fourth grader could understand it? Obviously, know what I'm saying. Is it simple enough to where it's getting the point across? Can't fill my story up with 1,000 slides. I've done that before, but then I always get a message at the end that's like, can you break this down for someone that,
Exactly.
and then I'm like, I have 40 stories. I have 40. So it's like, I get what you're saying. Yeah.
Yeah.
It's the
So
weak strength.
it's a strength because I mean, it's a wealth of knowledge. But what we're going to do here in this format, which I have no idea what to title, we're just, the genesis came from, hey, we need to chat, right?
For sure.
And I want to send you on a direction right now, actually. So Sharan Srivatsa, right? He was president of Real. Now he's president of acquisition.com. He posted an awesome carousel that I was like, perfect week for him to post this because I want to ask Donnie about it. So I'm going to read it to you, and I want you to kind of break it down even simpler. So he said the Fed cut rates 3 times this year. Inflation dropped from 9% to under 3%, yet your mortgage is still 6%. Flashy hook. Here's the reason why Wall Street doesn't want you to know how mortgage rates actually work. You're Yeah, I swipe right.
I'd read on. Yeah. Why the hell am I still paying?
Right. So Sharon says mortgages are long-term loans. You're borrowing money for 15 or 30 years. Lenders don't price those loans based on what happens overnight. They price them based on the 10-year Treasury bond, which reflects where investors think the economy is headed over the next decade. Right now, the 10-year Treasury is yielding around 4.2%, but mortgage rates are sitting above 6%. So that's the first point I want to ask you about. So I guess super high level, what is the relevance of specifically the 10-year Treasury bond, right? And then what does it mean? I mean, obviously, a little bit above fundamental. We know what a 4.2% yield is, but what does that number truly signify? Like, why is it important that it's, 4.2% positive, not closer to zero, possible negative, et cetera? And how does that, play into these mortgage rate pricings, if it does at all?
Right. So I'm going to go even simpler. I'm going to talk a little less numbers and more. What does this mean? We'll go with positioning, right? Of what the 10-year chart is doing. I wish I was on my laptop and I pull it up, but the 10-year, it's my favorite chart. I love that chart. I put up an analogy not long ago talking about the bond market. And I said, the bond market is kind of like being backstage at a play. You're backstage, you see the princess in a castle on stage making some cry. And then you look behind the curtain and you see a guy putting on a dragon costume. And then you see another guy putting on a knight costume. You don't exactly know how the act is going to play out on stage, but you have a feeling, you have a pretty good idea of what's about to happen. So it's kind of a foreshadow, but you can't really be like, oh, because there's a dragon and because there's a knight, the dragon and the knight are going to fight. Or maybe the dragon rides the knight, or the knight rides the dragon in to save the princess and fights him from an arm. There's a lot of different scenarios how it can still play out. It's not just because the bond market, watch the bond market, doesn't mean you're able to see the future, but you can kind of have a little bit of foreshadowing, right? So that's why I love looking at the bond market more importantly. But the 10-year bond market in general is a really good indicator of investor confidence and safety. There's a few other things that dive into it regarding debt. Foreign countries, Japan and China are two of the top three. I'm spacing on the third that are buying American debt. The reason they'd be doing that is because several reasons. I think people are going to start buying bonds more than anything else. Investors within the United States or even nationwide, because of the reserve currency of the world, everyone has to trade in the US dollar. That's kind of what the act was after, I think it was World War II. It's like, hey, we'll be the world's police force, and you have to trade in the US dollar. We weaponize the US dollar value, which is why BRICS has been a really big talking point lately, because it's not, well, we don't want the US dollar. It's, we don't want to trade in the US dollar anymore. We want the freedom of our own currency, because if we print, half of our economy in 1 year, that really screws with other countries too, not just us. So that's kind of what that's about. But when you see places like Japan and China buying American debt, typically that's because like U.S. debt, excuse me, not like yours and ours, but U.S. debt. when they're buying that debt, it's because they think one of two things. And I'm leaning more into the bigger one, which is they think the dollar is going to get a lot stronger. So if they have more of the debt, or excuse me, a lot weaker, so their debt is devalued, they can devalue their own debt by holding more American US debt and then by trading it over. And then the flip side of that is if the dollar does get stronger, they can sell the debt.
I wanna contextualize that even a little bit more. So you could tell me if you have something else that's a little bit better.
And I was trying to go, I was like, I wanted to keep it confidence and safety.
Yeah.
Biggest thing, got confidence and safety.
Okay, so confidence and safety, you started with this analogy of like it's like being backstage in a play. I think the character you use is like if you see a knight dressed up in armor, you don't know exactly what's happening in the play, but you have a good idea there's at least going to be a knight on with armor at some point, right? What does that mean in terms of like these, I'm going to speak insanely plainly, like these hills, these troughs, these, rises and falls.
So it gets a little trickier when you're looking on the shorter term.
Okay.
This is what one, yeah, one,
So
two.
I just switched it over to 10 years.
Now see down in 2020, what happened in 2020?
COVID.
Yeah. How stoked were people about confidence in the United States markets when we closed down everything? The trading was closed down, import, export, you couldn't travel. It was not a safe thing. That, and we also printed, a crap ton of currency. Debt meant nothing because it was free money. You could get mortgages for, 2%, 2.5,
Mhm.
right? So no one wanted to hold bonds because they can make way, way more money investing in hard assets. And the confidence in things like the stock market weren't great. But so that was February 10th. March 14th is when we close everything down. So right in there,
Yeah.
yeah, was when we closed it. So that's 16th, right after. So the very bottom is probably March 14th, around that time.
Yes.
After, right after we had a little pivot, and then like we need to figure out what's going on. What did we do? We printed $1 bajillion.
Right.
And then bought assets, started buying all of that, but then we had to start increasing rates.
And for context, we're talking right here, just looking at this chart from tradingeconomics.com. On March 23rd, because I just barely moved my mouse, we're at 0.7859. What does that mean?
Do what?
This number here on the right side, 0.7859. You want to explain that?
Yeah, I don't want to dive too much into
Okay.
how it works rather than what you're looking at.
Okay.
That's how I learn the best.
Sure.
Um, Again, low confidence,
Low.
or yeah, just low confidence in the U.S. dollar.
So does this just mean quite literally if someone bought a 10-year note on that day, that is what that note was going to yield?
So your return isn't, not great.
Yeah. Got it. Okay. So we see this, we print $1 bajillion, we start seeing this upward trend and bringing us over to today,
Yeah, 2022 is when the Fed really started hiking rates,
right?
which is where you start seeing that the bonds for safety, and then all kind of on a decline a little bit.
It's okay.
Myself, yeah, I'm kind of just
For context, I'm totally blindsiding with this.
totally fine. I just don't want to like dive in. No, you can keep that up.
Okay.
Helpful, but the thing right now is it's if we were to stand back and go back to the original questions, the 10-year confidence and safety, and then the other thing is it's just Alex Mosey is actually a proponent of this during, I think it was probably 2021, 2022. He's like, oh, I don't hold my money in checking or savings account. I buy Treasury bills and I do that. You can borrow and blah, 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 blah. And he went on that. And then, then it was like a good news for a stock. And people are like, no, that means who's the guy, the infamous dude on CNBC or MSN or whatever. It's like, buy Tesla, crashes. Buy Bitcoin, Bitcoin crashes. Do not buy Tesla. Tesla skyrockets. I forget his name.
Yeah.
Inc. something or whatever. Yeah, it's like that. So Alex Mosey kind of had one of those endorsement. He wasn't endorsing that, but he was just talking about how he does his financials. But coincidentally, a few months after that, it became not the play to do because then you didn't have any good yields and things like that, and you couldn't borrow from him as easily. Right now, let me back up. I'm kind of going down another rabbit hole. Confidence and safety, biggest things. Look at the bond market. Why is it not affecting mortgage rates the way it should be, or people think it should be? Because we're
Hmm.
lowering the federal funds rate, but my mortgage rate is staying kind of higher. And there are there are a handful of reasons why that's happening. In part is because how many of these banks have 2%, 2.5% mortgages on their books? They are
Hmm.
literally liabilities to the lender at this point. They're
Hmm.
not assets they want to get rid of those loans. If they drop everything back down, maybe they're break even, maybe they're making a little bit of money. The Fed rate was 0 and you have a 2% mortgage. Basically, obviously, I'm not diving in all detail. And you have a mortgage at 2.5%, the bank is roughly, give or take, making 2.5%. And what I've always noticed over the since the 70s, is a bank tries to stay at that 2% rate. So if the federal funds rate is at 4%, you can expect a 6% mortgage rate, or expect something like that. They're trying to make 2% of their money, right? What is where a fund manager fee almost, right? That's kind of, at least, I don't know if that's exactly how it works, but we're talking big pieces of the pie right here. Bird's eye view. That's a good kind of rule of thumb. Fed rate 0, you're going to expect 2% rates, which is why, I have a thesis that we get to see lower than 2% in the future. So right now, what's going on is that the markets are pricing in not federal funds rate cuts, but what basically Jerome Powell says. So if he says, maybe we'll have a rate cut 6 months from now, price in the market the next day. That's how it's been going. That's what's been happening. So you're seeing all this, but the mortgage rates don't react the same to the mortgage rates are stuck with the federal funds rate. The markets are, you know, reacting based on what Jerome Powell says, not what they're doing, what they're saying, which is why when you saw 6 rate cuts next year, people were like, hell yeah, I'm throwing all my money into the stock market. Why would people throw their money into the stock market if they're expecting uh, Fed rate cuts?
I mean, probably because they're expecting people to start borrowing, leveraging, and growing again.
Right. Why would people borrow? I'm trying to break it down to simple questions you can ask yourself. Why would people borrow when the federal fund rate is lower,
Because their debt is cheaper at that point.
cheaper? Which is
Yeah.
why bonds start going up. Because
Mhm.
people are not interested or people are more interested in buying assets than they are buying, or excuse me, I had that backwards. Buying assets more than they are buying safety
Mhm.
and things like that. Because if debt is free and it's really easy to get, that's pretty safe. If I fuck up, I'll just take more debt. The cash is king kind of stuff only applies in higher interest rate environments, things like that. And going back, I'm starting a rabbit hole again, or sidetrack. People put their money in the stock market when the federal funds rate goes down, because typically when that happens, you start seeing people borrow, you start seeing people spend, you start seeing inflation go up and up and up and up and up. The stock market is basically just a really good tracker of inflation's effects on companies. I'm not saying that companies don't grow in value and things like that. Tesla is great. That's a giant company. Meta, the Mag 7, all the tech fees, I think. But they're propping up the stock market right now. Mag 7 has been propping up the stock market for a hot minute. So that is all based on inflation. And what happened in yeah, there was a chart. I don't know if I have it. I wish could pull it up on my computer, but I had a chart. I was just talking to a friend of mine about this the other day. But if you do not account for inflation and you look at the S&P 500, it's not something you would invest in when, if you were looking at it just as a plain investment portfolio. Here's my performance. It would be, it's not bad. It's not great. Inflation plays a big role in that. And the federal funds rate plays a big role in inflation, which is why they raise it and lower it to fight off inflation, to turn it around, things like that. They want to slow growth. They don't want to stop growth, but they want to slow growth incredibly, and they want to bring the prices down.
Mm.
So that's how federal funds rate is used in that regard. So whenever it goes down to 0, stock market goes up, people start investing in there. Asset prices typically go up as well, because you can take out a lower mortgage rate, a large amount of debt for a lot less. Right now, we're not seeing that because the confidence isn't that great in the market.
Down. And the question that ultimately I want to get to is real estate as an asset class today on October 20th, 2025.
We started diving more into markets and how that operates and stuff rather than real estate. In 2010, 20, 2025, is an interesting one. I bought a house almost 2 months, a year and 2 months ago, almost. I bought the house totally expecting it to go down $50,000 in value. But the next, I didn't buy it for an investment. I bought it for my family. It wasn't like you know, I was expecting to take out, I needed stability for my family. I move around a lot. If I don't, just pick myself to a spot. As we're seeing in the conversation as well. Um, Today, and we just got done speaking about a few clients as well.
Yeah.
It is a little tricky because you're buying, I don't want to say stagnant asset, but because there is appreciation and things like that. How much of it is inflation? How much of it is forced appreciation? There still are strategies to get that, but you're not seeing what you used to see, pre 2020 or pre COVID, even. Or
Well,
San Diego, 8-10% appreciation.
month over month. And, our generation came up as one, entering adulthood in home buying age at a time where where we experienced 27% year over year appreciation for a few consecutive years in San Diego, which is, a lot of zeros that, weren't necessarily assigned to your net worth before. By the way, still not. It's tied up in a house. And I think that you said you bought because you wanted to provide the stability for your house. And I think this goes along with for your family. And I think this goes along with my rule number one and really primary philosophy when buying real estate. And that's you pull the trigger when it makes financial sense for you to do so in the current reality of today. So it's almost like, having the knowledge of the market and understanding the relationship and potential future impacts of rate cuts and this is what the 10-year note says is nice and good and important. However, what is more important is the market you have today is the market that you have today, and you pull the trigger and you execute if it makes sense for you to do so.
Yeah. And even then I would push back on that a little bit.
Mm.
For a few reasons. Everyone always says zoom out, and real estate always makes sense. And I get that, right? I get it. So over 10 years, you're probably gonna have more than you would now. Why is that? And we dive back into an inflation. The reason I don't think that is as true today as it used to be is if you look back at the federal funds rate in the history since the 60s, 70, I think it came around 70. If you look, the chart has like what the economy was doing before it was even established. The Dow, you can see the Dow, like what the economy was doing before the Dow was actually tracking it, kind of thing. It's like a forecast. It's not super reliable, but you get it. If you look at the history of the Fed and the federal funds rate, how it goes is we'll say this is the very top, and we are all the way over here. So this is the very top. We're all the way over here. Back here, we're flat, and then it's okay. Now we have a recession. So they raise rates, you cut it back down. The next bottom of the rate cuts were below the bottom of where all the problems started. And we're good. And the Fed decided to start raising rates again, bring us back to normal. And then right around the time we get back to where all these problems started, something else happens. Another recession, X, Y, Z. This is the problem. Maybe we go a little higher, give or take. And then what does Fed do? They cut rates, and they cut it down lower to when the last time the bottom was. So it's the new bottom is below. And this is 100% every single time.
Mm.
Why are they doing that? Because it's really easy to refinance the problem rather than solve it.
Mm.
And the problem we're in now, and the new market we're in now, October 10th or October 20th of 2025, is that in 2011, when we were back at 0% rates, roughly 0% rates, that's where we stayed. 2011, 2012, we stayed near zero for a very long time, 10 years. It was like 12 years, I think, when we stayed at near zero rates, next to nothing. The federal funds rate, that is. And we stayed really low, maybe went up to 1, came back down. Again, I don't have my chart to reference, but we stayed low enough to where it really didn't matter. So we were building all this debt on next to free money. I mean, I don't know if you remember 2019, 2018. I was getting out of the military around that time. 2018, 2019. I remember seeing really nice houses in Oceanside for $500,000. I'm talking 3 bedroom, 2 bath, gorgeous front yard, backyard space, 10 minutes from the ocean. Good luck finding even a $500,000 condo in Oceanside right now. It's a 3-2. Maybe you get one parking spot, maybe, but you might have to share that with public parking with how San Diego's go. Well, it's changed a lot. So I'm getting that because we doubled the economy basically. So over that time of the 12 years, we built all this debt up. And it was always easy to raise the budget and we'll just keep spending more money in Congress and things like that. The United States can keep spending more money because, we're not really paying that much. And then this is why you're seeing Trump push for lower rates. You always see the whatever administration, it doesn't matter. They're trying to commune or, speak to the middle class, the working class, lower class, people that are working basically, or not living out or living off the government. They try to speak to them saying, we need to lower rates because we need our people to be able to buy a house at a reasonable rate. Okay, that's true. But also the main reason is because they need to refinance the debt because we built up all this debt when rates were so low and now rates are not low, which is why there's always these big fights back and forth of the budget and why the government I think is still currently shut down. Is it still currently shut down?
It is.
Yeah, because we're trying to spend money on things we literally can't spend money on. We don't have 0% borrowing power anymore. We don't get to borrow from 0 or near 0, 1% or near 0 or near 0 debt anymore. Because where the Fed is that's why Trump keeps going with his hard hat to meet with Jerome Powell. The
Let
moral
me.
of that,
Oh, good.
I'm just kind of giving you some
Yeah.
preface of why that's important. So we built all those problems there. And now the Fed has a problem, an issue, which is why real estate isn't reacting the same way to the federal funds rate, is they can't lower the rate below where all these problems were crossed. That's why we stayed there for so long. Because eventually, when we repeated that cycle from the 70s, late 60s, early 70s, all the way down to 2008, and then we came back up and then right back down in 2011 to 0, near 0. We stayed there. And then I think it was 2019, end of 2019, or September 2019, guessing off of cuff, we started raising rates. And guess what happened in 2020? It's like, I'm not saying, who knows? Maybe there was a needed reason. Maybe there was something else. I don't know. But the markets can tell you everything once you start seeing, hey, this is not normal. What is about to happen? What is going on? We should not be doing this. So every time we do this and go above this point, what is the saying is show me the chart and I'll tell you the new.
Yeah.
We started raising rates in 2019, not 2020, not when COVID, all that stuff happened. And it might have been like 2018 where we started raising rates. And then it was 2019, 2020 before COVID where we saw rate cuts. And we saw rate cuts start coming down. That was before COVID was a big thing. And then next thing you know, boom, back down to 0. Where do we go from here? Is the problem, and the Fed doesn't have a good solution for it because their solution every single other time has been to drop the federal funds rate below the last recession, below the last problem. And some people are saying we're not in recession and we're not in this, we're not in that. They changed the definition of recession twice or something like that in the last 4 or 5 years. We've had a couple mini recessions. There is still growth in the economy, but again, it's a growth in the private markets, but it's really again based around the mags. And then also you're seeing them lay out people now too.
Mm.
So we're in a weird spot. Yeah, it's
Me-
not really a simple answer with
Yeah.
what's good.
No. Before we continue on that, I just want to re-summarize the problem statement itself. So essentially, you're looking at the history, you're looking at the timeline. All right. Generally speaking, you have raising in federal rates, right? And to a point where something happens, and the solution, right? And sorry, say that again.
Something breaks.
Yeah, something breaks, and the solution, because it's an avoidant pattern rather than an actual solution, is to regress to the previous threshold, right? And that threshold continued to be challenged in the downward direction until most recently that threshold became 0. Right. So the problem statement is, where do you go where your previous, your templated answer to this problem is to regress to something below the previous where the previous was 0.
Right. And that's why I have my thesis about We could see below 2% interest rates from mortgages and stuff. There's a lot of things that have to happen. And the biggest thing, which Trump has been doing, which people, this is what I'm saying, this is the angle a lot of people are kind of missing. I'm not saying I'm the only one who's saying this. There's plenty of people that probably already know this. They just keep their mouth shut because they're in a way more influential position than I am. Is that the tariff talk? We have to do a extreme fundamental restructure of how our financial system is working. We have to start with why you see states starting to talk about removing property taxes and doing this and doing that. It's great and all, but it's not, because you see some states raising taxes. You see other states getting rid of taxes. Those two seem like they're the opposite effect, right? But they're more of just trying to compete for people to stay in this state. And these people have so many people in their state, they're just trying to take as much as they can to handle the problems they're working with, because the Fed can't bail them out. Yeah, it's two different solutions to the same problem, is that the Fed is stuck and they can't do anything about it. So going back to the fundamental restructure, is we don't have anyone actually fundamentally restructuring. Increasing taxes in a state that already has high taxes isn't a fundamental restructure. Increasing taxes in a state that already has low taxes isn't a fundamental restructure. The only fundamental restructure we have that's been going on in the US is the tariffs that Trump has been doing. And to his point, one of his things is, I don't like everything the Trump administration does. I think they overturned a few VA things that I think they said was a win, but it was a Biden era policy that was great. It was the water. Yeah, they overturned it because it didn't make enough money. It was, if you were, yeah, I might have done around the whole VA waterfall. Look into it. You can still do it and you can still qualify, but it's on its way out.
But really, really quick, and
Right.
encapsulating what you mean by fundamental restructure, you're comparing, essentially a solution put forth by a couple of different states where it's like, hey, it's a populous area, already has high taxes. The taxes are how the government gets money, right? This is like OG political science, right? You have a bunch of people that devote some of their resources to, Thomas Hobbes wrote the Leviathan, right? Devote resources to the Leviathan in exchange for security, protection, and public goods, right? In states where they need more of that, the lowering of the taxes, although counterintuitive, ideally attracts more people to go to that area. And in turn, they get more of
Competitive.
those resources from the individual level up to the Leviathan level. So
Right.
that's what you mean by fundamentally two sides of the same exact coin, where it's not fundamental restructuring. They're just trying to get more out of the individual.
Yeah, just being more aggressive on the same thing.
Yeah.
Again, the only really fundamental change has been how we're doing tariffs. We've always kind of had tariffs, but not the same way we've been doing it. Which I think is the only saving grace why we haven't seen a recession. I think tariffs prevented it. When we see inflation, we see a recession kind of coming, and then you have tariffs in place, and it kind of balances out a few things. Right.
Totally understand on the charts what you mean by that. But like, as far as the average consumer, when they feel or don't feel a recession, what is that experience like? Because again, most of our generation, we were kids in 2008, which was not the last recession, but the last one where I think people felt, right? There was a lot of, ancillary effects on the deck plates, as it were.
Sure. I mean, how does it feel going through a recession? Probably how a lot of people feel right now, where,
Yeah.
man, I can't buy a house. Hey, man, I can't do it. We're not quite in the same type of recession, right? Because we have to address the problems the Fed has kicked down the road. I wouldn't even say it's the Fed, the policymakers. Like they're all to blame. It doesn't matter which side. They're all to blame. They all kick the can. No one spoke about any of this for 12 years. So everyone was agreeance, raise the debt ceiling, kick the can down the road. Maybe there was slight arguments here and there and small ones here and small ones there. But going through a recession, I mean, it can vary for everybody, right? So there's some people that are like, oh, I'm so good. I'm still buying property. I have plenty of investors investor friends that are like that. Yeah, I'm still buying deals, still doing deals, this, that, and the other. I mean, one of them, they're still making profit doing deals and things like that. And some people have maybe increased their deals because other people are suffering more than they typically are. You have to get really budget focused. And I would say I reference rate value on it is funny is whenever you start working on paying your debt down, you're like, hey, I need to get rid of some of this debt. That's when you know we're about to be kind of in a recession. because it feels a lot heavier. Debt in 2020 and 2021 didn't feel heavy at all because it was so cheap and it was so easy to take care of. Oh, I just go make some more money real quick. In a recession, that gets a lot harder. You start seeing layoffs, you start seeing jobs cut, you start seeing companies go down. It's not all super doom and gloom. Recessions are healthy because we have an economy based on inflation or propped up on inflation for the last 50 years. The recession is always a good reset to bring it back down to, I can finally buy 2 gallons of milk. I'm breaking down really, really simple. Obviously, most people are still buying milk, but someone probably watching or listening or whatever will be like, yeah, there's some things I don't do anymore because I need to be a little more focused on paying my debt off. Irony is by the time you get the debt paid off is when the market turns around and debt is no longer heavy. And you could have refinanced all that debt and paid it off way easier. But life is life and you still have to pay your bills. So you're almost forced to address your debt problem. And you pay your debt down back. And when you get right down low to zero, market turns around, take on more debt,
Still
right?
relatively a good fundamental personal finance principle.
Do it. Yeah, yeah. I mean, although you don't want to, no one wants to be in like bad debt. Like
Yeah.
good debt is bad debt. Some people like Dave Ramsey will say no such thing as bad debt. I mean, I would love to have his bad debt for buying, 5 fourplexes in 2020. That bad debt would be doing pretty well. To probably would have sold it all, so by then. So it depends. Again, we have an economy based on inflation. There's good debt and there's bad debt. It develops how inflation affects the debt you have.
Yeah, you did a really succinct job, I think, of, encapsulating that feeling behind, hey, what does it mean to be in a recession? We said the problem statement being like we can't go back notionally. We can't apply the same template that we have before to solve the problem that we have. I want to link this all back to, your initial pushback to my statement of, hey, the best time to buy real estate is when you're in a good financial position to do so.
Yes. And I wanted to push back on that
Yeah.
because I bought a property that I would rather not have been paying for.
Mm.
I could rent something in my area about the same, if not better, considerably less than what I paid for my house. But I couldn't paint the walls. I couldn't change the backyard. I couldn't build a fire pit. I
So
couldn't things.
is your pushback or your thought process is the trade-off between asset ownership and lifestyle?
I think I think it's defining what you mean if you're ready or in a position.
Mm-hmm.
And when most people hear that, like, okay, I got 100 grand in the bank, or half a million in the bank, I got some money, good, I got some cushion, I'm in a good spot to buy a house. And it's like financially, yes, but how's your marriage? And how are 10 other things go? There's a lot of other ways I would say, to determine on if you're in a good position to buy a house.
Hold on a second. Pause, rewind 10 seconds, both of us included. There are two realtors on this Zoom call right now saying, hey, even if you have the money, maybe you don't buy.
Right.
Or maybe if you
Yeah,
have a
you
2.5%
could.
rate, yeah, and your house is perfect, maybe you don't sell. Because I think I would agree with that 100%. So I would modify my statement to be like personally and financially, when you are in the position, regardless of the state of the market, you execute, right? Where, if you've, taken care of your bad debt or whatever, you've saved or you have some liquid assets and you have a clear vision of what your life is like, where you want to live and or have an opportunity to live and what it takes to do that. And all those stars line up, you get the lifestyle, you get the price point, you get the monthly payment that you're willing to pay, and the problems that you're willing to inherit and can sustain, whether it's via your relationship or your personal stress, right? Then you pull the trigger.
I wouldn't say all stars, but if it's a very personal decision, right? So it's hard to be
Mm-hmm.
like, okay, this box, you're good,
Mm-hmm.
right? But I would say, hey, if you're in a spot where, like for me, I bought because I needed stability. I needed to pin myself down for a minute so I could provide stability to my wife and daughter. My daughter's turning 4 in a month, what's in a month now. She needed to like go to a place where she can go to like dance class. She's a dance class today. She needed a place where she could do that and start making friends, start going to school, all of that. I had to account for those things. If I didn't have a kid, I wouldn't have to account for that. And I probably would have rented a place and I don't live in another country again. I probably would have moved 3 months in, and then went to another country because I want to go check out that culture for a while.
And I'm
Uh,
chuckling because this has been a constant bane to my residential sales business,
yes,
is also trying to figure out where the heck Donald is.
I travel around a lot. I like traveling, not the act of traveling, but I don't like going on a 5-day vacation somewhere. I want to go live there for a year, and get to know the ins and outs of the culture, the nuances of why they, think cow is sacred or something. I would never live in India, but um, there's a culture thing there, and I don't know why. And I want to learn about why and actually connect with the culture, not see it from afar, basically, even if I'm there in person.
Yeah.
Sidetracking it. But going back, I want to go back 2 steps to the Fed. So talking about how you feel in a recession, right? So you start addressing your debt. Not everyone. We're not in a full blown, like the US is in a hard recession, markets are collapsing, things like that.
But sorry, on that exact point, but we're also in a position, I think, where most middle Americans feel the pressures of affordability, like you've already said, with the, fortunate place of like the jobs still exist for them to, I mean, it may not, you're not buying Lambos and throwing money in a pool and
No one
jumping
ever is.
over it.
Mm.
Right. But there are avenues for people to cover their bills more often than not. And I'm not going to say that like with a broad stroke, with that pressure, that pressure exists, but an avenue for solution on an individual level still relatively exists right now.
Yeah. And that is the kind of the point I'm getting to now is that some, we're not in a place where it's like it's impossible to pay my bills. There are still ways to pay your bills. Maybe it's getting a better job, working on getting a better job. Maybe it's getting a job. A lot of people these days,
We get canceled for that.
no, I'm only halfway joking, but I'm joking a little bit, but most people have jobs, right? But some of them are like ventures that, real estate's actually a really good example, believe it or not, where it's commission-based only business. You can do very, very well. I've been fortunate enough to be able to sustain my business for, and through the market we have now. I have consistent clients. I have referrals we send out. I know you've been sending out referrals as well. People in other states who people reach out to you because they trust you and on what you know about real estate as an asset and everything like that. But how many people came in real estate when it was almost risk free because again, debt was so cheap.
I was a part of that
Right.
graduating class. Yeah.
Yeah. So, a lot of people came in, not too many are still here. How many were on our team when my team at one point was like 25 people. And, over time just dwindled and dwindled and dwindled. And we sustained about 8 to 12. We had a few like kind of people sustained 8 to 12 for about a year and a half. And people were like, hey, I do something else. Hey, I'm going here. I got to figure this out. Because as the Fed rate was starting to climb, and people were saying, whoa, I need something a little more consistent. I need something a little more reliable. Maybe this job isn't for me. I need something I can clock in, clock out, and know for sure I have a better safety net. Because real estate, there is next to no safety net, right? Some people, agent attraction people will tell you, I have a solution for that. And I'm all for agent attraction, right? Build your brand, build your community, but don't conflate the two. Don't conflate a 9 to 5 with a downline or something. But we
were talking about the pressures.
Going back, because there's still ways to pay the bills.
Yeah.
You can still pay, but we're not in like a blood on the streets recession, right? We're not, there are people out there that can't pay their bills right now, for sure. But there are people that can, they just choose not to. And there are others that are like, hey, I'm working 2 jobs now, 3 jobs. My wife has a job. I have a job in the morning and I have a job at night, busting tables or something. Oh, I thought you were a real estate agent. Well, yeah, I have my license. I got that in 2021, like everyone else. So there's that. But I want to equate that to the Fed's issue right now is that they had to find the reason you're getting a job is you're finding other sources of income. You need to find another source of income to pay off your debt. And that's kind of where the Fed is at right now because we can't lower the rates. We can't make our debt cheaper and refinance it and then think all is good and merry and hope the economy, resurges and launches us up and we make all this money and we spend it correctly this time. We haven't done that ever, right? We've never done it. Not once in the history. We've never done it. We've never spent it correctly. And we've spent it on $10 billion on people that aren't even American insurance, health insurance, because the people got it.
You said it, not me, man.
My wife's Mexican. Her family, I have a whole thing. I'm all for it, but don't ruin it for everyone else. So they're trying to do it the right way. Come here the right way. I'm all about it. But I love Mexico. I lived there. I love it anyway. I know. So now the Fed has to get a job, basically. Hey, maybe stop trying to kick the can. It's time to face it.
So this is such a great connection you just made. I've never heard anyone explain it before. So essentially what you're saying right now is the American economy is moonlighting for Uber Eats, and Uber Eats is just tariffs for us right now. That's beautiful. That's beautiful. If your eyes glazed over during any other part of this, just think of that, because essentially what we're extrapolating the feeling, right, that people are experiencing right now is the same. If you were to personify the American economy, is the same pressure of feeling where there is an avenue, there are pressures where you have to pay your bills.
I don't want to do it.
And
But I don't
yeah,
want to do
you gotta sign up, you gotta do it. That is that's so great, man. Like I've never heard it explained that way before.
Yeah, so it's almost partisan to argue against the tariffs. You could argue that the tariffs can be done better and maybe more eloquently, you know?
You mean Twitter legislation isn't necessarily
Right,
the
right.
best way
Yeah.
to.
Little ceremony, but at the same time, like what do you want? You want someone else that is so elegant but has horrible policy?
So
So so elegant that actually has and people are like, oh, I don't talk politics, I just talk real estate. Well, if you're talking real estate, you're talking finance, and you're talking finance, you're talking politics. It's
right.
all like
And
so people that say that shit is just they're just flexing on ignorance.
right. Yeah. Yeah.
Yeah.
Two questions on that. One, I guess kind of more of a yes, no, because it could get blown up by a lot. But to your point, is this tariff approach to bringing additional revenue to our economy to address the issue that we can't address the original problem statement? Remember, we can't go below the previous threshold, which was the same templated solution that we've always had in our economy. Is tariffs what we would consider a restructuring of that solution?
Just start a restructuring,
Okay.
I think. Because the same thing is like, why would I tax my people? Why would I tax Americans to pay off the debt when I could bring in $4 trillion a year off tariffs and this, that, and the other? And it's like, well, like, oh, why hasn't anyone else thought of that? Well, because there's like a lot of ripple effects.
Yeah.
BRICS is a really good example of a ripple effect,
Right.
and among a lot of other things. So again, that's a whole conversation.
Yeah, yeah. Okay, so start. It looks a little bit different now than it has probably previously, and we're learning the field of what the consequences are. So the second question, before I try and bring us in micro just a tiny bit before I let you go. The second question is, what if I'm the blank avatar of an American home buyer or seller today on October 20th? Um, and financial distress is not a part of my resume, right? Who is buying and who maximizes their opportunity by buying today, and who maximizes their opportunity by selling today?
I am not going to pretend to know that answer.
Okay.
I will say but I believe in purchase owning more than I believe again going against someone else dictating what I can do in my own home, who I can have over, what I can do in my that's why so many people hate HOAs. This is my house, right? You don't get to tell me what to do. I understand HOAs, side note. I think some HOAs are reasonable, right? Mow your yard, don't paint your house bright pink when we're all brick houses around here, don't paint the bricks. Yeah. Simple things like that. But the same pushback people hate about HOA is the same reason I believe in owning. This is mine. I can do what I want with it. Um, I believe in owning. Believe this is my house and do what I want with it. I believe it's very important for a child to have stability. My role as a father is more important to me than next to anything else in my life. I want to make sure that I, you know, live up to what she needs and deserves. And I
Right.
think so. Going to the question is who's in a good position to buy. I think it really comes down to your principles. And
Yeah.
I don't think it's ever a bad idea to buy if you exclude financials. I understand that that's a very hard thing to exclude, but I don't think it's a bad thing to own where you live. I know plenty of people that say own in better markets and that Grant Cardone. Yeah, but Grant Cardone were literally like, you're an investor. He might, I don't even know. He might just be talking on his butt half the time. I don't like him. I don't hate him. You gotta respect him though. I don't think it's a bad idea to have something is your home that no one could take away. Right. So I think, and again, long term, I still do believe like you're not going to regret buying a house if you exclude the finance side. And this is what I mean when we get back to the who's going to be in a better spot or who's going to make out good if they buy a house, who's going to make out good if they buy. If we're only talking financial, I had no idea. I can tell you, my house went up like 50 grand in a year or something like that, which is cool. I was expecting it to go down 50 grand when I bought. I had zero financial outside of it. Can I make this work? I can. Cool. I'm doing it because I needed it in other areas of my life more than I did the financial side of my life. Financially, it's make more sense to rent. It's always going to make more sense to rent if you're talking about monthly payment for the most part. Like you have micro markets here and there, but, yeah. And if you're good at investing, good at saving, whatever, you don't even really need the equity because you can do it yourself. We're not in a market right now to where it's like, yeah, buyer, if you buy this house today, 2 years from now, you're going to have 20% equity. You can't really forecast that. It was irresponsible for a lot of people to forecast it, but it was the norm because rates were so flat at what they were for so long. So you have people that have been in the industry 20 years that have been in nothing but flat rate markets. I was around in 2008. Okay, well, good job. Good job for the warnings. What do you mean you were around in 2008? I love when people say that. Don't hate it, but I'm like, is that a flex? Oh, you've been to that market? Well, what did you tell your clients back then? Yeah, buy the house, get an adjustable rate mortgage. Why not? Buy three. What were you saying in 2008?
Yeah.
For
So
buyers,
it's almost so I think that's an unfair question. I think that's a really easy question that I put towards you. When I think the answer is back to first principles of personal finances and lifestyle decision. Um
and you and should.
yeah, can you and should you? That's perfect. Can you and should you? And that answer is not something that anyone else can tell you for you. I think I think if I were to pull that string a little bit better, what that question is coming from, it's coming from, our residential sales side where, we are acting as a fiduciary for clients. And I think the best, what people should be looking for in the agent is someone that's having that frank discussion, I think. Like, hey,
Mhm.
here are the numbers, just here it is what it is. What do you think? And these are the impacts, right? Not that, oh, yeah, you could buy now. And then, if you're going to be here for just 3 years, you can count on, leaving with the solid 50 or 100K. Would you rather be paying yourself or paying a landlord? It's like, well, I don't know if, putting your family in a terrible neighborhood just to get 3 bedrooms is the right answer.
One second. Yeah. No, it's a good point. I would say it's hard to, again, it's hard to say who's going to win, who's going to lose, whatever, because I think we are approaching that fundamental change in the market. And that's why why I was saying we could see a sub 2% rate from banks because we don't know. We can have negative interest rates. Negative interest rates are a thing. Like Japan's done it. Like you can do it. It's not a good thing to do, but it's not a great thing to do. You're basically penalizing banks for holding money. So you're making it less than free, and so you could get lower rates. So if you bought now, to play devil's advocate, if you bought now, there's one in place. Trump needs to incentivize, or whatever administration is in place by the time this happens. Someone needs to incentivize builders. Can't build right now because rates are too high. I can't borrow debt because lendings are too restrictive. They say, okay, well, the Fed gets on board or whatever. They say, we can't figure out our problem. We've been moonlighting for Uber, but we're only bringing in a couple grand a week. I need to bring in $10,000 a week. How can I do that? Well, I think I have to do this, but this job requires me to do this. I have to get this prerequisite, and a prerequisite for builders and things like that. You see all these people talking about investing into the U.S. to build. That's why Doge is taking on regulation. You can't. The fires in California, like there's no building, zero profit, maybe 3 or 4 of thousands of homes that have some form of building going on. And that's because they changed how the septic tanks have to be put in. I don't know if long and short is it went from basic septic tank to now you need a 7-story landing the septic tank down 7 stories to prevent erosion.
Mm,
It's overregulation. There's no way that someone can build, so they have to sell. No one's going to build there unless they're, crazy, crazy, crazy rich. And it's going to take a lot of time. So you have
actually,
to.
there's a hilarious headline there. I don't know if you saw, but one of the most recent California Powerball winners is buying. He's probably spent. I think the headline I saw was somewhere around 30 million buying Palisades property.
That's what. That's probably a tiny
Two
part.
doors.
Yeah, probably a tiny part. You have to learn. That's what I'm saying. You're not. It's not going to be even your good investors because it's not a good investment.
Yeah.
Um, to do that because then what happens when you get to the next phase of planning, the next stage, what new regulation you get hit with? So you got to deregulate. So people investing all this money to build these factories. Where are they going to build? Okay, places that are impossible to build or with crazy regulation. So you have to have the regulation drop down. Then you say, okay, now regulation is good. Now what? Now what comes next?
Yeah.
I'm kind of talking about prerequisites to make. I'll speed this up.
Yeah.
Is
You're devil's advocate.
right?
So you're devil's advocate right now of like, okay, you play the game, you buy now. And
How it could work out soon after financial regulation starts going down. And you've seen them attack regulation. You're seeing the pressure from dropping rates. They can drop rates down. And then they say, we need a little bit cheaper because all this stuff we have to build was bought or is built off debt or owned on debt that was at 0%. We still can't afford to buy it. We have money, but it's the trade-off. I'm building a gigafactory in Texas or something like Tesla or whatever. I'm trying to build a gigafactory in Texas. I'm not building a 3-bedroom bath, thing. So now you have to incentivize builders because the trade-off isn't there. You're talking about even trade where all the problems started to, I need to solve the problem, but I have to match, that level of wealth. And there's a lot of wealth in that problem. Maybe Elon could build a gigafactory, but look, we're talking about everyone else trying to expand, build, put up new everything. Excuse me. So then they say, okay, we need the banks to lend. And the bank says, I can't lend. It's a very uncertain economy. The bond market's kind of, looks like people aren't too stoked or looks like people aren't super interested or think that there's a lot of confidence in the future, the next 10 years of the US economy. I don't know. It's okay. It's not great. Yeah, these foreign countries buying our debt because they think something's going to happen with the dollar. Yeah, I can't. I'd rather not lend out on this project that I won't see returns on for 3 years, 10 years right now, 20 years right now because of regulation. Let's say the regulation's gone, and he says, "Okay, that's it. We're going to penalize banks for holding a certain." You have like FDIC, where you're like, if something happens, you're insured for up to $250,000. I don't remember if you saw when the banks went down
Mhm.
FDIC, if you had less than $250,000, you got it. You were so good. If you had over that, you only got $250,000. If you had 2 million, too bad. So I think it'll be something like that. It could be, where this is all hypothetical make believe land, where it's a reverse FDIC. Like once you hit this threshold of money on your books that you can lend out, or that you haven't lent out. If you're not at this threshold, you start getting penalized. So then banks are like, well, I don't want to be penalized because I'm not lending. And then they start lending at a little bit lower rate. That drops rates a little bit. You could see a negative interest rate. And then that would increase the speed of production on top of, that would increase the quantity of production while deregulation would increase the volume of production everywhere.
Mm.
So if that happens, negative interest rate for the Fed or next to zero, we have banks being pressured, not for residential sales, but for truly economic reform in the US. Residential purchases being easier to make happen would just be a byproduct of that. And it would be great. Most everyone will be stoked about it. So whichever administration does that pressure, they'll get a lot of flack, but most people won't really hate on them because they get to buy a nicer house, at a rate that they make sense for them. So that's where the win could come in.
Mm. But if I were just to ask you, like, when is that going to happen?
I mean, time in the market, time in the market versus time in the market.
Right, right, right.
I mean, I've been on this bug since like 2020. It's 2021. As soon as we saw, we printed, half of our economy in a year and a half, not even, it was like, oh no, we haven't even adjusted to that. People are like, well, prices are at these highs. We've never seen them before. Well, yeah, we doubled our economy. Well,
Yeah.
yeah, we did this. Like no one, it's like everyone just forgets their economy is double the size it was. So it's like I don't want to say all the metrics we used to base things off of are useless, but you need to, like the stock market chart that it doesn't account for inflation, or removes inflation. And this is how the S&P performs, just based on performance with no inflationary pressure, or vice versa, and propping up. And it's not that great. We need to also have a chart that says, when we're referencing things from pre-printing all this money, this was the reference point before, this is the point now. But if
Like
we scale it back down, we're actually lower than we were.
like a chart that measures equally before and after the gold
You
standard.
got to get rid of, I don't want to say chop it in half or chop it in, 0.5 or whatever, like take off whatever we increase the economy. I think it was like really like, I think it was almost double, if not a little more. But, so it's like every reference point we look at right now,
Yeah.
things are expensive, is in an economy that didn't exist 5 years ago,
Mhm.
already, in like the money supply and things like that. So it's a really hard thing when you talk about timing, because we haven't even adjusted how we can look at the charts and fundamentals of charting, and you know things in the stock market are basically ignored all the time now, because they're violated all the time rather than ignored. They're violated all the time, you know, because we're in a different economic system. It's not made for this. It didn't slowly grow. We blew it up overnight.
Yeah.
And so, going back to the timing, I keep going to that because it's so important to take into consideration when you're looking at how expensive things are. And it's not just because of inflation. Affordability is definitely rough, but it's not just because of inflation. It's because there's so much more money floating around. You thought there was a lot of money in 2019. There's so much more out there now. And it's not as strong, maybe, but it's like the Venezuelan money. It's like, who has a $10 million bill? Like, why would I have $100 bill? I don't have a $10 million bill. And now, our money stayed the same, but the currency's value scaled. We might as well have a $500 bill instead of a $100
Yeah.
bill.
Yeah. But that question of like, hey, when is that going to happen goes back to the discussion of, our advice and the way that we talk to our clients, insofar that, like, you don't know. That's why you're saying time in the market versus timing the market, right? And that's why everyone says that. It's a cliche. It's terrible to hear. It's, you stick to the first principles. If you're an investor, I would say, the numbers have to make sense for, like, you can't, I can't imagine the number of real estate investors that just made it on sheer luck, like totally mismanaged projects and terrible, comping numbers to flip properties still into great profit margins during the boom economy, or like the boom housing market of COVID, right?
That's,
Arithmetic is arithmetic.
and that's why commercial real estate is
Yeah.
still in such a bad spot.
Well, that and lending, I feel like that's a whole other thing.
Yeah. But I mean, it was easy to make commercial,
Yeah.
it's like, add square footage, change its use case or adjust its use case. If it needs to be rezoned or whatever. Square footage, add 10 more units, and yeah, add 10 more units. That costs this amount. Cool. We'll borrow it, put it in there, sell it. Done. But then you had people buying more and more and more because money was so cheap. And then they're like, oh crap, we can't offload these anymore because money isn't zero. And it doesn't make sense unless money is free.
Yeah.
And it's like, it really checked a lot of people. You see that everywhere, any hard asset. You see that in all hard assets, cars, you see it in, I wouldn't even say cars, hard assets, but you know what I'm saying? Like, you see that everywhere with people in sales, brokers, regardless if it's a yacht broker, if it's a mortgage broker, whatever. People that are brokering the deals outside part maybe. You saw that skyrocket, now it's plummeting. That bubble pops, and the commercial real estate debt bubble still hasn't popped. It should have popped by now. Again, I think we're kind of in that stalemate where we should have been pushing into a recession by now, but tariffs, we picked up Uber Eats, and now we have Uber Eats and we can keep ourselves afloat a little bit.
Yeah.
The way Uber Eats, we are toasted. We're not being able to pay us, and we're going to default on our debt.
Yeah.
So, unless we get rid of Netflix and Hulu, and maybe instead of having 4 cars, I have one, maybe instead of 3 vacation properties, I have one or done, meaning maybe instead of all these different arms of government and programs and services that are, I would say, for the most part, useful. Let's take away regulation of things that create assets and start regulating programs that are used. We just need to be a little more restrictive on those and dial in how we're spending our money.
It's an interesting meme coming from this shutdown right now is, the people waking up in day 20 of the government not functioning and realizing their are the same.
Sure.
Right. Right.
But
And there's some meme to it. There's some underlying things that they don't like, the meme doesn't inform on, but there's a fundamental satire there to like, okay, how much do we need is becoming the question, right? Which is an interesting question to explore.
I'm a big proponent of small government outside of a few things, but I don't want that to influence how I'm looking at the financial markets. But I'm looking at how we're spending money because again, the premise of the conversation was, hey, what Homie that is now the CEO or now the
Yeah.
guy at acquisition.com said, Fed is cutting rates. Why is my mortgage still the same? That's not a real estate conversation. That's a financial conversation. It's not your house that is so expensive is why your mortgage is so high. It's the rates,
debt.
the debt attached to it, right? So it's not even the same. You can just buy a smaller house, like it's just the value of it. How much, obviously, a smaller house in a worse area is going to be less than a large house in a big area. Okay, that isn't the reason why all the houses are expensive though. The house in Escondido, far east of Escondido or El Cajon, where you're like, oh, you live by the ocean. They're like, no, I haven't seen still San Diego County. I haven't seen the ocean in years. It's not quite the same. I like that. I like that area too, though. It's got its own little natural beauty as well.
Yeah,
But
yeah.
I prefer the breeze from the Pacific all the time. Constant AC year round. It's great.
Yeah.
You pay for it. But again, to the point, it's not that breeze has always been there. It's not the breeze isn't getting colder and better and more efficient. That's why your house is more. It's inflation, it's the debt attached to it, which is why your mortgage is higher. Mortgages are interest, front loaded with interest. Some people are like, okay, I'll buy a house. And I'd rather pay my own house than pay landlord. Well, it's like if you have a $4,000 a month mortgage, $300 probably is going to your principal for the first like 5 years. $300 on a $4,000 mortgage because it's front loaded. It's not, your payment stays the same, but how your payment's broken up is not the same. A lot of people, that's more of like an in the weeds breakdown of what PITI is. Your payment's the same, but interest it should be IP. There should be IITI. It should not, or IITP. It should not be principal, interest, taxes, insurance.
Yeah.
IITI. Because they front load that interest and very deceptive acronym, but they front load it very, very heavy. And so you're paying interest. You're not paying yourself. You're not paying into your equity. $300. Okay. You could rent that same house for
And
$1,000,
Yeah, and save $1,000 to your PM.
paying yourself $700.
Yeah.
Like, dumb argument. It's not dumb. I get the idea. Okay. But it's outdated.
Yeah.
It's outdated and it's spoken from people that don't understand the gravity of how much our current financial structure is affecting real estate prices and why it's not being affected the same way it has over the last 30 years. I bounce around a lot, but that's something I really want to focus on. Is it is very important that you understand that it's not, oh, San Diego appreciates 8% a year. It's not even that it appreciates a year. It's not San Diego gets 8% more valuable a year. In some case, it is. It's a landlocked area. I'm speaking about San Diego, but this is, macro market. It's the same story. But micro for San Diego County, if you want to call San Diego County micro market, very much a macro regarding finances, financial sector. It's a micro market. It's landlocked. You don't have much space left. That's why you see ADUs everywhere now. That's why you see there's no place to park in downtown because there's nowhere to put parking. So yes, there is a value increase because there's nowhere else to buy stuff or sell stuff. So your unit that used to not have anything around it now has 10 other units around it, but you still have the best view. Your property is going to be way more valuable, right? So it's not just that it will appreciate in that sense.
Yeah.
It's not San Diego appreciates 10.
It's not the elevator pitch of yesterday.
2 to 4% increase. If you had a 10% increase a year, 2 to 4 of that is because of the value of your property.
Yeah. Let me try and tie a bow on this so you can go. Oh, 10-year. So the initial presentation or the proposed question was, hey, why are your interest rates 6% when the 10-year note is at 4.2 or something like that? Why do you look at the 10-year note? It's because of, you said two words that I loved. I think it was confidence and safety. Is that right?
It's a good reference point for investor confidence and safety.
Yeah. So that is why you're looking there. And then the problem statement of when you look at the history of that note is that the templated solution that we have to when things break is to go back just below the previous point that marked the growth, right? However, today I kept on saying we can't, but I realized more accurate way to frame it is it is difficult to, but not unfathomable to go below the previous point to apply our templated solution. So what does that mean? The American economy picked up Uber Eats and we're trying to cover the bills. All right. If you're going to try and buy, you have to go back to your first principles of can I and should I? Right? If you're going to sell, there's a lot more that goes into you, but it's really can you and should you still first principle. Because we've experienced clients where they actually couldn't sell. And but it's so important because you talked about things in the way, like in the vernacular that people hear about it every single day on the news. And then we experience it in our business from our clients, right? This market hesitancy, not because they know if they can or they should. It's because there's fear, there's other behavioral influences surrounding the decision that are clouded and influenced by a lot of the things that we consume and are faced with. Like even myself, right? Like how many times have you and I had the conversation of I understand the need to grasp macroeconomics and finance in order to understand the influence in that the headlines have on our real estate market and, as an externality, our particular business. So I think that is a more than sufficient, if not clicky. I love it. I see it now. U.S. government on Uber Eats drives for Uber Eats. I think that's
I'd
a
say it's a
really
better
good
job
starting
than
point
Uber
for
Eats.
these discussions.
I say it's a better job than Uber. It's a passion project that could replace your 9 to 5.
Oh, there you go. There you go. Where can where can people connect with you if they want to connect with you?
Instagram, Donald Appleberry, Facebook, Donald Appleberry. Text me on there. Message me on there. I'll probably use my number. I post stuff on my stories. Little snippets that are usually a little better formulated. Because I get on a roll like as you see here, and I start rabbit holing. I tend to want to over explain. So on there, I'm forced to keep it short, keep it sweet. U.S. economy or U.S. picks up Uber Eats. Yeah, is a side gate. Yeah, connect with me on there. Shoot me a message. Give me a call if you need something.
Yeah, man. And I'm on Instagram at official San Diego Steve. This will go up to to my YouTube channel, and Donnie will definitely get these clips. But we're on the same team. If you talk to one of us, you'll likely get to both of us, especially here in San Diego. That is all. We're gonna try and do this weekly ish.
Better prepared. We got just showed up and jumped on.
Let's do
So,
it.
all right, go on
Yeah.
the marks. Break it down. I was like, okay, I need to probably make sure I'm a little better prepared for it. But it was good. I mean, for the most, the state of the economy is the state of the moral you summarized is where we are. I don't want to say semantics, but the inner workings of it are a little less important for someone that's just like, hey man, should I buy a house? Here's what to look out for.
Hey, this is how we what did you say? Go fast, break things, right? Here on Appleberry Real Estate. All right, see ya.